My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends? I'm just trying to make you a little money. My job is not just to entertain, but explain all this to you and educate you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. With the market growing a little more tepid after a furious advance, Dow sinking 40 points, S&P inching up 0.1%, NASDAQ inching up 0.08%. It's the perfect day to answer a question I hear endlessly. Hey, why own anything else when you could just own the Magnificent Seven? Why bother with a drug stock, an industrial bank, when you could have just bought one of these highly visible winners? There's a simple answer, and that is diversification. You never really know what's going to work in advance, so you need to spread your bets across multiple sectors. Last year, for example, the Magnificent Seven were terrible performers. You'd be kicking yourself if you owned all of them and nothing else. But there's another reason, and this has to do with something that you and I have to work on. It's how difficult it is to own high-quality stocks, how difficult it is to stay long, so to speak, especially if you listen to the whamma-jamma pros, the researchers, and the traders. There's a phalanx of experts that are literally out there to get you to trade, to get you to sell. How else will they stay relevant? The bias is to get in and get out, regardless of how good the underlying companies might be, which is why these 7 stocks are among the most heavily traded in the business. I think owning these stocks through the gauntlet of Wall Street, is a Herculean task. So let's go over what might have kept you from holding the Magnificent Seven and making big money this year. I'm going to use the charts to demonstrate how difficult it really was to get to the promised land of the higher prices. Perhaps it'll remind you to hold on to them or buy them back into weakness when you actually see the visual, the pictorial. We're going to start with Alphabet. This stock's been tough to own for a host of reasons. 2 Justice Department antitrust investigations, AI challenge of Microsoft, and the possible faltering of the Google Cloud. At the same time, though, Alphabet does have this amazing franchise of YouTube, and of course, it's got a remarkable search business. When the company reported, it told a botched story on its conference call where you got the sense that Google Cloud had lost a step, but they weren't going to tell you why, and that the NFL Sunday Ticket, the YouTube, that we didn't know it was doing well. All they did was tell you that it was paying NFL a lot, and they liked it. Now, if you're going to stick with Apple after that quarter, you had to believe that management simply just didn't tell the story, particularly of the NFL Sunday Ticket, well, and you had to avoid being freaked out by the Google Cloud shortfall. Now, I actually think that there's some truth here that the Google Cloud is bad. They should have done better. I also think, though, that the whole conference call was not great. It's hard to convince yourself in the heat of the moment. In short, there really isn't anything wrong other than the glitch in the Google Cloud. I just wish they'd explained it, because that would have kept more of you in it. Instead, people left. And instead, I think now we realize it was a mistake to sell. Next is Amazon. Now, that had been a rocky story for ages. In June, you had the FTC file suit against them for their Prime offering. In September, the FTC sued Amazon again, being monopolist. I mean, one of the most fanciful briefs I've ever encountered. You routinely heard that Amazon had far too many employees as they hired way too many people during the pandemic. We've been watching that slow-motion market share erosion of Amazon Web Services for years. So there was just a lot to dislike. And don't remember here, they had a terrible quarter, and they had terrible expenses, and people didn't think they knew what they were doing. Now, when we got the actual quarter, Amazon Web Services clearly was gaining share from everybody else. The retail business turned out to be tremendous, and so was advertising. Because of worries about the bond market and inflation, remember, those can play a role in the valuation of a stock, Amazon stock had been tumbling lower into the quarter. After that quarter, though, buyers came in and stayed in because the numbers were truly remarkable, and the cost-cutting here is just relentless. So we went down quickly. We shouldn't have. And then it's been up. They did some cost cuts even tonight. I think that of all of them, this is the one that's most likely to go next to new high after Microsoft. We'll get to that in a second. Third, Apple's always hard to stay, and we know that. We had analysts downgraded right up into the quarter, saying negative things right about them when they went to the print. The wrap was simple. Apple's got no phones that anyone's really excited about. China's awful. Sales have been stagnant. It's not a growth stock. What would have kept you in Well, you had to realize that the story is becoming much less about hardware, much more about the fast-growing service revenue stream, along with the opportunity to add billions more users in developing countries. Given the unbelievable customer satisfaction level for Apple products, it's only natural that you buy the services once you get the phone, creating a fantastic business model. Plus, China turned out to be fine. Now, just so you see, this is going up, 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 because people just said, you know what, the 15 is going to be terrific. Then down when people realized maybe there wasn't that kind of growth. Then down again because of China. And now I think we're in an up phase. That's what I think is going to happen. Fourth, Meta Platforms is crushing it in the advertising world. Their TikTok killer, which is Reels, is so far ahead of plan that I think it'll eventually rival TikTok in profitability. Instagram's red hot. WhatsApp is worth tens of billions of dollars. However, the outbreak of the war in the Middle East caused a temporary slowdown in advertising, one that's already bounced back from. And I think when Meta reported, it obscured all the positives. The stock never should have been down on something that predictable. We frequently have interludes where the advertisers pause because of some sort of cataclysm around the world, but if the marketplace is good, they always come back. They have to advertise, and that's exactly what happened with Meta. So if you want to take a look at this one, what you will see is, again, people realize that things are getting better, better, and better, and then all of a sudden, we get worried that there's a glitch. Now, just so you know, this thing went down all the way to here and then came right back as people realized, you know what, there is no problem. The advertisers are there. I think it takes out that level. How about Microsoft? In the previous quarter, CFO Amy Hood crushed you on the conference call when she said there was a lot of upfront expenses for AI, okay? And then you saw this, boom, all right? But there had not yet been any material pickup in revenues from AI. Here you had to wait a couple of quarters for increased AI adoption, the introduction of both the Copilot and the product, and the GitHub Copilot deal, a more expensive version, which just came out. So what hurt the previous quarter? It ended up being what hurt this, ended up helping this. Because they didn't have the revenues from right here from Copilot, and here they're starting to come on. You had to buy Microsoft in the weakness, as we advised members of the CNBC Investing Club, because you had to believe this great company would eventually be able to monetize its AI investments, and now that's exactly what's happening. Number 6, Nvidia doesn't report till November 21st, but the stock's been tough to own ever since it had that blowout quarter back in the spring, okay? The stock's been meandering aimlessly. Here we have the huge number, and then this is what's, and because it hasn't been able to break out, people are saying, you know what, maybe it's finished. You're enduring all sorts of catcalls if you own this stock right now, like a potential slowing in hyperscale spending or government ban on ultra-high-tech chip sales to China. These worries have been enough to shake out tons of investors, especially since the stock's expensive by traditional metrics, something you can't really say about the other members of the Magnificent Seven, except for maybe Tesla. Every time Nvidia stock dipped, people fled. This is the stock I'm most asked about wherever I'm wandering the streets or going when I'm leaving an Eagles game. I think Nvidia is still not believed. It was the last to be admitted to the $1 trillion club, and it makes chips that are vital to artificial intelligence. But many people simply don't believe that any one company could possibly have that whole market to itself. Yet Nvidia really does. It's practically invented the market. It's got a huge edge on everyone else. Remarkable, but true, which is why I always say own it, don't trade it. Finally, there's Tesla. This is a tough one because unlike its magnificent compadres, Tesla actually did report a not-so-great quarter. You have to stay in for the X factor. No, I'm not talking about the fact that Elon Musk owns the company known as X, Twitter. The X factor is Musk himself. That's why, like the others, I can still recommend buying Tesla. But unlike the others, this is a pure cult of personality play. While I'm very much a believer, I also know this is a difficult moment for the auto industry, so owning Tesla requires a leap of faith. Now, in this rundown, I haven't included the myriad times the bond market sent you a signal to sell all the high-growth stocks. It doesn't include the endless attempts by the strategist class, especially Mike Wilson from Morgan Stanley, get you to sell. Leaves out the price target cuts, the downgrades, the negative channel checks, and the like. Doesn't emphasize all the work by the Justice Department and the FTC to hobble these companies, often to the detriment of the consumer. It doesn't include the endless discussions about how the Magnificent Seven are always overvalued. Newsflash, they've been overvalued since they were born. But the bottom line, even without these considerations, it wasn't easy sticking with the Magnificent Seven. You had to fight so many trends, so many obvious pain points, so many outspoken naysayers. Remember, as obvious as these winners seem in retrospect, it was very easy to get shaken out, and most, at one time or another, have been shaken out, perhaps even multiple times. Joseph in Florida. Joseph.
Hey, Jim. Booyah.
Booyah, Joseph. What's going on?
Hey, man. I just wanted to say thank you so much for having me back on the show.
My pleasure. What's up?
Hey, so I was just wondering here, considering Intel is less expensive than AMD, do you see Intel being a better investment for the long term?
No, I don't. I think Intel is, frankly, and we talk to ARM later on, I think you're going to hear that Intel can inch up, but ARM can go far, far faster, particularly even though ARM has been hit in the aftermarket. How about Jim in Florida? Jim.
Hey. Hi, Jimmy.
Hey, buddy.
So, here's my question.
Sure.
I bought L3 Harris around 200, and I thought it was a great buy because aerospace, defense, and Florida Institute of Technology, all right here. So we've got a bright crop of engineers, and we have good weather. But the stock has lagged. And,
but you know what, Jim? Sometimes the stock is wrong. I am going to urge you to buy LHX. I think it is an inexpensive, good defense contractor. Selling it 14 times next year. Pick up LHX right here. As obvious as these Magnificent Seven winners seem in retrospect, you have to remember it was very easy to get shaken out. That's why I always emphasize the importance of doing your own research, not letting yourself be swayed by the feelings of experts, and let us help you with the CNBC Investing Club. On Made Money tonight, Dutch Bros has fallen from its year's highs, but after spending the last month creeping higher, is this the turning point investors have been waiting for? The West Coast coffee chain going east? I'm getting the latest from the CEO. Then members of the CNBC Investing Club are familiar with our position on Humana, but after last week's earnings update, is there more to the story that we need to include in our thesis? I'm sharing where I come down on the name. And ARM Holdings, one of the most anticipated IPOs of the year, reported a first quarter, and people are selling it like it's going out of style. Is that the right thing to do? I've got the exclusive with the CEO fresh off the report. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.